Michael Burry, who is famous for spotting and shorting the housing bubble in 2008, recently warned on his Twitter that he thinks the 2022 stock market crash is only halfway finished. Burry argues that the correction we've seen so far in the stock market has been due to multiple compression, but that earnings compression has not been priced into stocks yet. And because it hasn't been priced in yet, he warns that the stock market may have further to fall. You may be wondering exactly how multiple and earnings compressions work and what Michael Burry is actually talking about here. Multiple compression is when sales or earnings multiples investors are willing to pay for a company's stock decreases. For example, look at this chart of Netflix's stock price at the top of the chart and its historical price to earnings ratio at the bottom. When Netflix was growing subscribers rapidly and expanding its sales back in 2018, investors were willing to pay a much higher earnings multiple since its sales and subscribers were growing so rapidly. But as sales and subscriber growth started to slow down, the earnings multiple investors were willing to pay for the stock started to decrease or compress, meaning that investors were no longer willing to pay as much for the company's earnings since growth was starting to slow down. This compression puts pressure on the share price of the stock, since it's effectively investors being willing to pay less for the company's current earnings. Multiple compression can be caused by a lot of things. The example with Netflix is an example of multiple compression relating to a company's sales growth, since companies that are growing quicker generally have higher multiples and slower growing companies have lower multiples. But another common form of multiple compression is when interest rates change, like what's currently going on in the economy with the Federal Reserve raising interest rates. When interest rates are higher, investors can make more money buying government bonds and other forms of loaning money by collecting the fixed interest rate payments. This ability for investors to make more money through loans at higher interest rates means that the opportunity cost for investing in stocks increases. Since bonds are a lower risk way of making a return and the rate of return for bonds is increasing, investors can start to allocate more money into bonds instead of the stock market, which generally starts to compress the multiple of the stock market. This phenomenon especially hits companies that are still in their growth phase and not currently profitable, since investors are less willing to wait years for a company to become profitable and generate returns when they can loan their money out in the present and start generating returns immediately through interest payments. Another way to look at this concept is that investors start to value their money in the present more. Since rising rates means there is increasing ability for investors to get a return on their investment in the near term through fixed interest payments, they are less willing to pay higher earnings or sales multiples for stocks, since making a return on that investment through the company growing its sales or earnings will take longer than it would for the investor to start making a return by collecting fixed interest payments that they can generate in the present. Michael Burry notes that the multiple compression in the stock market is what has already occurred, since rising rates have been one of the main drivers with the stock market correction in 2022, and multiples have been lowered significantly in most stocks already. However, the second kind of compression Michael Burry mentioned is earnings compression. And Burry believes that this hasn't occurred yet and is what will make the stock market crash further. What Burry means by earnings compression is an actual decrease in corporate earnings for publicly traded companies. As rates rise and economic activity slows down, many companies will have their sales and earnings reports come in lower than previous expectations from financial analysts. Since the actual earnings of the companies start to decrease, the stock prices for these companies will also need to decrease the corresponding amount in order for the stock to trade at the same price to earnings or sales multiple it did the quarter before. If the company's earnings decrease and the multiple stays the same, the stock price has to decrease in order to realign with its original multiple. Since Michael Burry believes that the economy is headed for a recession and slowing consumer activity that will lower corporate profitability, he's expecting this to provide the second set of compression on current stock prices and continue the stock market crash to the downside. What are your thoughts on Michael Burry's warning? Do you think that the stock market crash will continue and that earnings compression has yet to take place? Let me know your thoughts in the comments below, and be sure to like the video and subscribe to the channel for more finance content. Thanks.